about debt service.
Okay, so good evening, everyone, and welcome to the Almus monthly market webisode series. First and foremost, I'm pretty excited to share with each and every one of you that we have completed 12 monthly webisode series in the last financial year. It's a monthly webisode series started in April 2023, and this could be achieved with the help of each and every one of you. In fact, I thank every one of you, all the participants. There are many who look at the webinar, view the webinar on the Almus YouTube channel. Most importantly, all the esteemed speakers, and we have many of them who have been more than willing to offer themselves to share their insights. And that puts us back into the series every month. So really, really thank you each, every one of you. Now, today we are on the 13th webisode series. Now, while we were naming it, there was this question, and traditionally we went on with the numbers, the count. We said 12, now 13. But we have a Zenzi member in our team, Harshul, who came up with a modern touch to the titling of the webinar. And he said, how about coining it as a season 2, episode 1 and not episode 13? So here we are. We have completed season 1, 12 series, 12 episode, and now we are in season 2. And this is an episode 1. So that's where we are, and welcome everyone to this season 2 episode 1 series. And I also thank the Almus backend team who have been really working tirelessly over the last 1 year to make this happen. So thank you all once again, and keep encouraging us by your participation. Little bit about this topic, which is being kind of, I would say, most talked about of late.
Some connection error, I think.
I'm in. Okay. I got the message. And I'm sorry, I don't know why I got dropped, but I'm in back. So continuing from the earlier part, we have the topic, and topic I'm actually saying, and I'm going to say, इस gold को मैं क्या नाम दूँ? And to cover this topic, why am I saying it? Currency, traditionally, that is how we are looking at it. Asset, because the kind of return that it has given. Jewelry, it is definitely an ornament. One would really love to be and love to wear it. So there are multiple naam to a commodity. And to share their insight, we have with us speakers who are really into it, both on the financial market side, on the retailer side, on the user side. And I'm going to briefly introduce all of them. First, I will begin by introducing Sanjay Banka, who is a chartered accountant, a company secretary with 30 years of rich experience working in the many corporates. And he has been one person who has been instrumental in successful execution of Senco IPO. So he is the Senco CFO, the head HR. And thank you so much, Bankaji, for being here tonight to this evening and sharing your insights with us and with all the participants. Bankaji has been a speaker at many professional forums as a finance and industry advocate. He has also written some of the papers. In fact, he has authored one book on USPC civil services exams for an NCR-based NGO. So welcome, Bankaji, to the Almus.
Thank you, Maulik.
We have with us Gnanashekar Tyagarajan. In fact, he is a celebrity market analyst when it comes to commodity. He was awarded the best market analyst for the category commodity market bullion by the then finance minister and president of India, Shri Pranab Mukherjee. In fact, he has been writing his columns in Economic Times. His views are sought after by CNBC, Bloomberg, TV, ET Now, Z Business. In fact, most of you may already know him through his connect in money control. In fact, he is the voice to be heard when it comes to commodity. He covers agri, precious metal, base metals, and today is going to share his insights on gold. Thanks, Ghana, for being here in the Almus episode. And Ankit Sharma. Ankit Sharma is the director at Almus. He is a founding member at Almus. He has been working as an MBA finance with almost 20 years experience. And he was part of the Rosy Blue Treasury team before being a founding member at Almus. And one of the things that I'll talk about, Ankit has been extremely bullish on gold. And with the date, I can say on 18th of October, he has written a paper where he predicted the gold movement with the time bound and the quarter bound timeline. And he has been someone who's been extremely bullish on the metal, on the gold, and we will hear his insights today on this webinar. And thanks, Ankit, for, I don't have to thank you. You are the host, so I'm sure you will help me even putting few questions to the speakers this evening. So,
with pleasure.
Yeah. Now, just a little bit on how this session is going to go. So we have about an hour time. We will extend it by max 6:15. Speakers have willingly agreed to maybe extend it by another 15 minutes, but we'll try to complete it by 6. Now, what we plan to do? The flow session will be in the first half, which is roughly about till 5:30. We will hear from the experts, Ankit and Gnana, experts on the financial market, their insights. Both of them have a presentation to make. First, I'll start with Ankit and then Gnana will take over. And in the second half, we will have a free-flowing conversation with Bankaji. Bankaji is someone who's been at the retail end. He knows exactly the market on the ground. And there are many participants who are keen to understand the gold hedging, the instruments that you use, how a corporate, or there are many upcoming corporates who are coming in the listing space. The wealth of experience that Bankaji brings on is what we will take it up in the second half. So that's how the flow of the session will be. Let me first straight away begin with Ankit. Ankit, over to you. You can start your presentation and then we'll move on to Gnana.
Thank you, Malik, for the introduction. It is my pleasure to be here and also share podium with my fellow panelists, Pankaj Saab and Gyan Shekhar, both stalwarts in their own fields. To begin with, Malik, we are in those times where not only the gold merchants, but treasury professionals, risk managers like you and me, and also individuals, retail people are also keenly watching the price action of gold, keenly watching the price movement of gold. Not many people were expecting such a sharp price movement in such a short duration. Everybody wants to know what is likely to happen in the gold prices going forward. Now, before we jump on to what is likely to happen, we have to understand what has happened in the recent past. As gold traders, and we have been working together for almost 17, 18 years now, we have always known and seen that whenever interest rates go up, a low yielding commodity like or a no yielding commodity like a gold prices comes down. And that is, we have seen this repeating over and over, over the number of years we have seen. But interestingly, in the last hiking cycle, which started in 2022, the US interest rates went up from almost zero to currently 5.5% now, which is the highest in the decade. And at the same time, we have gold prices hitting new all-time high. And there is a story behind it. So let me share the presentation where the story starts. Okay, so where the story starts, actually, okay, the story starts here. Now, what happened during the COVID period? Is my screen visible? Okay, so what happened during the COVID period? There was a supply. There was a huge supply of currencies across countries. So it is visible in the chart how countries across the world printed money, especially the US. What the data we have received, it appears that more than 4 trillion worth of dollars were printed during that time. Now, obviously, it had to trigger the asset prices rally globally. Now, these are some of the charts that I'm showing you. And this can be seen in number of charts, number of asset classes. This is S&P 500. The prices since the COVID time, the price of or the value of S&P 500 doubled during this period. Japan doubled. India Nifty doubled. Copper prices almost doubled, or in fact more than doubled. Bitcoin. Now, Bitcoin is I can only calculate how much. So where other asset prices only doubled, or maybe more than that during this period, Bitcoin prices shot up more than 13 times during this period when the easy money policy started globally. Now, interestingly, the gold price 25%. So it was a severe underperformance of gold during this period. So it may appear that the gold prices have gone up substantially, but if we compare it with the other asset prices, it has been a severe underperformance. As can be seen on the chart, the rally was only 25% during that period. Now, the recent gold price rally is because of a very critical reason. I think everybody is aware about it. These are the two gentlemen who triggered the recent price rally. Now, instead of Russia-Ukraine war in February of 2022, there were, and subsequently the interest rate hiking cycle in March of 2022, initially there was a drop in the prices. And price of gold came down from almost $2,000 to $1,600. It was almost a 20% drop in the prices. But somewhere in the middle of those interest rate hiking cycle, China started accumulating its reserves, and it can be seen in this chart. Basically, it is a World Gold Council chart. It says that's from October of Q3, as in Q3 of 2023, China started building its reserve, which was stagnant for a number of months and number of years. So the last gold purchase was done by China was in 2015. So for almost 7 years, they had a very stagnated gold reserves. But because Russia's money was sanctioned by US, it triggered this reserve was result of a fear that happened in China, and they started accumulating gold reserves. During this period, India also, so India's reserves have been continuously going up. So essentially, the China gold purchase and the India gold purchase basically triggered the recent rally in the gold prices. Now, what is the outlook going forward? So in fact, as you said, Malik, we had predicted that in October 2018 itself, in October last year itself, that considering that we already have a supply, a currency supply, prevalent in the market, and now since that the Chinese central government mostly is buying gold reserves, building its gold reserves, the prices it's only a matter of time that the prices goes up. We had some technical parameters to look forward to, which suggested that by April of this year, as in we were projecting that in the next 6-7 months, we will be touching $2,400, and incidentally, it did. So this is where we are right now. Most likely, this rally is just a start of a major bull cycle, which will go on for a number of months. Now, going by the history, what we have, the recent two incidents where prices have shot up significantly. One in 2009, where the price of gold shot up from almost sub $1,000 to $1,800 over a period of next to 3 years, and in 2002, where the price of gold shot up from sub $300 to 420 over a period of next 3-4 years, which is almost a 100% rise in both these cases. We are in a similar situation at this point of time. However, both these instances, as can be seen on the chart, these after the breakout, which we have already seen in the price, there has been a significant pullback of anywhere between 15 to 20%. So that kind of a pullback is possible, but that pullback probably towards 2250 or 2200 would be a great buying opportunity before price touches or goes towards 2800 in the next several weeks and months. That is the initial comments that I have.
Thanks, Ankit. Let's hear from Gnana. Gnana, start your presentation.
Yeah. Thanks, Maulik. Thanks for the opportunity. Go a long way back, and I've seen you from Rosy Blue days, and really congratulations to where you've come up and the team both, and congratulations specifically for the 15th episode. It's not easy to conduct these webinars, and I'm really glad to see that the participation is increasing and people are really getting to sort of like the webinars that you're presenting, and I'm personally watching them myself. Really like it and appreciate it.
So we are like you earlier as a participant and now as a speaker.
I'll get to the topic. Yeah. So let me get to the topic quickly. Basically, I've been watching gold prices quite some time actually. Right from, if I remember my banking days back in early 2000, the price was around $100 odd. It was languishing around those levels at that time, and 9/11 happened. And that was a time when the Fed went and started cutting rates like crazy. That's the time it really started taking off. So till it was $100, I think no one even bothered. If I remember right, it was England who went and sold some of the reserves, saying that it's a zero yielding asset and it's a waste of having gold. So they were at that time. I think European banks were major sellers of gold reserves that they were holding. So right from that time, I've seen the way gold has progressed. It's been a one-way ride so far, almost 24 years now. So saying that, let me get into the presentation straight away. I hope it's visible. Yeah, great. So I've just briefly put the various factors at play at this point in time. I think Ankit also dwelled on some of these factors, but basically the undercurrent is this. The central bank buying is very prominent. That's really taken prices to a certain level and beyond that. Because if you remember, gold, even lately, in the last 4 or 5 years, I've been finding it very difficult to cross certain levels, which is around $2275 or thereabouts. 3 or 4 times it couldn't do that. So there was still this sort of doubt whether anything could really push it higher. But it was a sort of it was inevitable that gold is going to cross these levels anytime soon, and that's basically what happened. And it was largely triggered by some of these bullish factors that you're seeing here. Essentially, central bank buying, diversifying the reserves into gold, because many of the central banks, especially the Asian ones, have very, very less amount of gold in their reserves. And they have their own other reasons also, trying to de-dollarize to some extent, because maximum reserves many of these central banks are holding is in dollars. So during these inflationary times, uncertain times, there is this inclination by central banks to diversify into other assets and physical assets like gold. And investment demand, I must say, is something which has really picked up. Gold has proven itself as an asset class, giving amazing returns, or in fact, as much as stock markets, I would go to say that. And it's given the confidence to investors over time that they've only been getting higher and higher returns. So it's become a compulsive portfolio diversifier in many, in many portfolios, even individual, retail, high net worth. It's become a compulsory part of the portfolio. So investment demand has really taken off, and it's at a peak at this point in time. Even though prices are at a peak, I think investment demand continues to be robust. Another important factor which I think many could be missing is the China retail demand. Now, we all know China is a big buyer. In fact, they've overtaken India in terms of overall buying as far as gold is concerned. One of the reasons is the recent, stock market debacle that we saw in China. So investors there have started moving towards gold, and we all know, China's appetite is so huge, and retail is start. We have real estate issues in China, which has been ongoing. So that asset is also underperforming in China. So a lot of money is now moving into gold as a replacement for equities, a replacement for real estate. That has been one of the major triggers, according to me, that has really led to the sharp, move. Because most of the conventional factors, the geopolitical uncertainty, all that has been there in the past also. But this time it has combined with the Chinese factor, both retail and central bank. The Chinese central bank is also buying gold for their own reason, because they also would like to de-dollarize. They don't want to be, victim of sanctions like what happened in Russia. So that is one sort of reason why central bank in China has been buying a lot of gold. And we all know stock markets. I mean, I can't say it's a peak. I'm not a stock market expert, but basically, the way it has gone up and the returns that it has generated, it's going to be tough to sort of justify valuations and sustain at these high levels. So that is also sort of leading people towards gold as a safe haven asset in terms of any uncertainty which could pull prices down. Now, another key factor is the rising US debt. That is also one thing. US investors are extremely worried now. The world is also worried now because the debt is at a peak. And even if the new president comes in, whoever is going to come in, is going to find it difficult to service this debt going forward. For God knows, they could even default in some of the debts. So these are all factors which have led to investors going towards the safety of gold. And that's ensured that prices sort of break the all-time highs, and it's still ruling at all-time highs. De-dollarization, like I was talking about, is again very critical. It's been talked about so long, but gradually is seeing it in practically taking place. This BRIC currency, then you have India itself started rupee payments. So clearly, I think each and every country is now given a choice, would like to get out of the SWIFT system, but they can't because trade is still being done in US dollars. But eventually, I think that's where this is leading to. So ideally, gold would be preferred as a fiat currency, or at least it will be linked to gold. Many of the currencies could be linked to gold going forward. like how it was, back in the mid 1900s. So all this put together is something which I thought I'll capture as all the bullish factors currently in play. But the traditional bearish factors are typically gold being a zero yielding asset and therefore not in the portfolio or not preferred by fund managers, not preferred by investors. That still continues. When that's the reason why when interest rates rise, it's not preferred. But when interest rates go down, gold as an asset is really preferred. Jewelry demand, traditionally it tends to be weak at high prices. But what I've seen in my own little personal experience is that jewelry investors tend to get used to high prices and then it starts moving up again. So it's just a question of getting used to these higher prices. Now, sticky inflation and hopes of rate cut is receding right now, because in the beginning of the year, there was a lot of hope that there will be 3 cuts, 4 cuts. And now, this very idea of a rate cut is being questioned at this point in time, because the economic numbers have been so strong. It doesn't warrant a cut, and everyone is looking at Fed, and Fed being a central bank would be very embarrassed if they start cutting rates and then inflation starts rising, and again they go back to rising rates. So I think they would take quite some time, bide their time, look at data, and if there is a need, because the current economic environment doesn't warrant a need for a rate cut, but so that dollar strength on the back of that is slowly starting to creep in. And that could sort of put spokes in the wheel as far as gold prices are concerned. And broadly, I wanted to touch upon some of the important slides that I thought I should take you through. In this particular slide, I just want you to see that this gold jewelry demand has been consistent over the last 20 years or so. Only during COVID time, 2020, there was a sharp dip. But after that, it's been on the rise. Even though prices have remained at these elevated levels, there's still a lot of appetite for gold jewelry. That's going to keep driving. But what's interesting to me is the ETFs. If you can see the pink color ones, that's the ETF which hasn't yet given any kind of a competition for all the other sectors. I think that is what will aid in this entire rally, because more and more investors move towards ETF. I think prices can really take off in a much bigger way. And these kind of uncertain times, a lot of funds, even hedge funds, are all moving their money into the safety of gold to a great extent. So this is very important to watch out for. The ETF numbers, they've been more or less standard. It hasn't risen much, it hasn't come down much, but I think there's a scope for it to go up. And generally, the gold supply-demand dynamics, typically as a commodity, people look at supply-demand, but gold, it's a little different. Conventionally, market, especially the precious metal market, don't look at gold supply-demand for directions. It's largely external markets, which is the dollar and the macroeconomic sentiment, the interest rates, and all that. But just to take a peek at the supply-demand, I think it's more or less neutral. Supplies remained steady with slight increases, but demand is really on the verge of a takeoff. So even there's going to be a slight deficit, and that's going to further support gold prices higher. And like I mentioned before, I think China is the driving factor in this rally at this point in time. Both retail as well as the central bank, all of them. The signals coming from there is very clear that they will continue to keep buying gold. Turkey bought quite a bit of gold. We all heard about inflationary, the way Turkey went through an inflationary crisis. So wherever you see this inflationary crisis now, and it's quite evident that the way crude prices are moving, any kind of disturbance in the Middle East is going to lead to higher crude prices, and that in turn leading to higher inflation. So clearly, these things are going to have a major effect as far as gold is concerned. Again, what we can see here is there's a lot of scope left for many of these central banks, and especially China. They have huge amount of US treasuries, and they could start dumping US treasury if this trade war between US and China starts. Again, if Trump comes into power and that starts, I think they would threaten the US by dumping treasuries and buying more gold. So that possibility is there. And that scope would put it even more in a bullish territory. The dollar index, this is house view. When I say house view, it's a personal view that the dollar in the short term could strengthen if it crosses 107, 108. We could revisit 115 if rate cuts don't happen and inflation continues to be sticky. Then dollar could strengthen again. So that could be the only negative factor to me, because of which gold prices really can't take off in a big way. So quickly, the de-dollarization, like I said, the BRICS and the potential impact of that on gold prices are going to be very strong. But I wanted to just look at this important slide, the total debt of the US government. It's literally rising by $1 trillion. We've seen many times when the Senate had to approve, and because of that, the government itself has shut down a couple of times. And gold prices at that time really took off as a safe haven, and it's a likelihood in the future too. So that's going to be a major thing. But what is important is the interest rates and gold. Post 2021 is when it really diverged, and even now the interesting part is, even though rates have sort of peaked and showed some sign of receding, gold prices are still going higher and continue to go higher. And one of the reasons is because of the Chinese government buying, the central bank itself buying a lot of gold for their own reasons. And because of this environment, the long positions in gold are increased like crazy lately. So just to give you a peek into how the funds are holding positions right now in gold, right from February 13th onwards, they've been majorly buying gold. Whereas the producers and users, the blue line, the light blue line are the producers and users, and the green line is the funds. So you can see that they've been behaving exactly opposite, because most of these producers who've been seeing 2000 level as a very important resistance have all been hedging. Whereas funds have taken a stronger bullish view, and they've been buying the market right from right from February 13th onwards. So this is the time. You can see a blue arrow here. That's exactly the time when funds have changed their view and they've gone bullish like crazy. So that's one of the reasons why you've seen this take off exactly from that particular date. This is again very, very interesting, because this is the CFTC position of funds in COMEX gold. Look at the, I've circled managed money. You can see managed money, and I've circled 32.9% and 6.8%, which means funds are net long by at least 25%, whereas the producers and users are net short by 6%. So that much of fund buying has taken place. In fact, when there are funds which are skewed to one side, like what we're seeing now, a potential downside correction could also happen, because they're not attached to positions. They can simply start booking profits. So that threat is also there. So that could also ensue sometime soon. But a broad outlook is that, based on the projections, both the technical as well as fundamentals. When I say fundamentals, we've always known that inflation adjusted price of gold is way above $2,400 even last year, when it was ruling around 1,700, 1,800. So it's a question of catch up. So what we're seeing is a catch up. But from here, with all these bullish factors that we have seen, it could potentially rise to $2,700 odd dollars, which is a way of equality target. And typically in this kind of a move, in a momentum like this, it can extend to 1.618 times, which is around 3,700. So I'm not putting that number because that's a very sensational number right now. But it is possible that we can see this if there are all these bullish factors that continue to be in play, and geopolitics escalates. I think it's quite likely that we could reach that. So that's the outlook. And back to you, Malik.
Thanks, Nana. So what we have is the two bulls giving their own projections. Ankit talking about 2,800, Nana talking about 2,700, and stretch up to 3,007. Like there are a number of factors that we already talked about, both Ankit and Nana. What I'm going to now loop you in is the key person in the room today who's at the effect of all of that. And let me now invite Sanjay Banka. Bankaji, we have in the room today number of participants who come from a jewelry background, both in the listed and unlisted space. They are very, very keen to hear from you. Looking at the bullish scenario that we are hearing from the market experts, and looking at what you are experiencing on the ground, what is the key trends in terms of the retail demand at a higher price? We just had 66,000 in March and we are at 71,000 plus. How are you seeing that demand shaping up at a higher price point?
Right. So I will use some of the slides to answer the question. But to set the context, India has been importing around 700 to 800 tons. So you have got the exact number. I'm just quoting around the number that India has been importing around 700 to 800 tons of gold every year, as against the global production of 3,600 tons. The jewelry sector consumes around 560 to 600 tons. It is 60% of total. And out of this, 40% goes to organized sector, sort of the sector to which we are representing. So in 260 tons, and at Senco, we have been selling around 6 tons. So almost 2.5 to 3% market share. So one large jewelry retailer, Pan India, they have reported some time back around 25 tons of sales. So this is the context. So your question was, what is the future trend? So very clearly, we have talked about the gold price rise. In the first place, as a jewelry industry, we are not impacted by the gold price rise or fall as far as our profitability in terms of inventory is concerned. People have a perception that if the gold price is rising, the jewelry company makes money. So there are different types of jewelry company. At Senco, we have said earlier in the earnings call also with a lot of emphasis that we are hedged more than 80%. It is 80 to 90%. Sometimes we are hedged 100%. So when we are fully hedged, we don't gain. So if the gold price is rising, so part of it is hedged by the gold metal loan we'll discuss in detail, and part of that is by MCX future sale. Net, we don't gain by the gold price rise on account of inventory or price rise. That is negated or mitigated by the hedging position. Now, since the prices are rising, there obviously will be impact. The customers will feel pressurized on his wallet. So the customer's wallet size is always limited. It can vary from 80,000 rupees to 3 lakh rupees to even for a rich person, for a general middle class person, 20 to 30 lakhs. People can spend 2 crore to 3 crore also on wedding. So when the price rises, volumes clearly take a dip. So, and the same trend, I think most of the jewelers must have seen in March as well in April, that the customers is now in a wait and watch mode.
So is that the usual trend, Bankaji, that when you have a price rise, like Nana also talked about in his presentation, the price rises, customer gets adjusted, and then it becomes again back to the demand. So you will immediately see a pressure on the demand, and then gradually it will have an acceptance. Is that the general trend?
No price. So even if you've seen the World Gold Council report, they have ascribed multiple reasons to the price rise, and two major reasons is the risk and the momentum. So price rise is also due to the momentum, while it is obviously due to the due to the de-dollarization, due to the central bank buying, and due to the Ukraine war, due to the Fed rate. But a major risk is that the momentum which is there. So customer also comes into wait and watch mode, but that is not more than 1 month time, because uh, here the customer has to make a purchase. If the marriage is happening, they will buy anyhow. They will reduce the weight. So if I have to buy 60,000 and the gold price has increased by almost, let's say, 15 to 16%, I will rather reduce my weight from 10 gram to 8 gram, or from 8 gram to 6 gram. So that is one trend, that there will be more focus on the lightweight jewelry. There will be more focus on the 14 and 18 karat jewelry. So if I still want a chain with a proper weight, which should look larger, then obviously I will go for a 14 karat chain or 18 karat chain. So these are the two particular trends which we'll see at least in Q1. And once the prices are stable at this level, which we are saying that the customer is clear that it is between 2,300 to, let's say, it rises to 2,500. So that customers, once they accept the reality, then the full blown impact and volume rise will happen.
So you also talked about Mankaji, the hedging policy, and the increase and the decrease in the gold price does not really impact you. Now, I mean, I can tell you there are many participants already. Some of them are in unlisted space, and additionally, you will find those who are in the unlisted space remaining unhedged on the gold. Now, how do you debate? And they have their own reasons for remaining unhedged. And you are very clear that as a policy we remain hedged. What is the real? I mean, what is the right way to do it? Both businesses are flourishing.
See, so let's say unorganized sector. See, nothing is right, nothing is wrong. It depends upon what is your growth journey. Where do you see the prices rising? And in a rising price, obviously people want to make money from the inventory. So nothing wrong in that. But as far as the listed players are concerned, we have a set of public investors. You've got mutual fund, large funds who have invested in the company. And that applies to other listed players as well. And they have certain expectations. So when we had gone for the IPO, when we were on the roadshow, out of all the 200 to 300 questions, this question was either the first or the most important question, that what is your hedge percentage, how you are hedging, how you have been hedging for last 5 years. So they don't look at even current. So all the unlisted players, if they want to go for listing at any moment of time, the investors will look for their hedging practices and policies for 5 to 6 years. And they will have a lot of difficulty to explain. So whatever is your gain on account of non-hedging, that has to be explained, that will be reduced during your restatement. And if not from restatement, the investors will reduce all the gains out of hedging gain. And then they will try to avoid your the real business gross margin and real business EBITDA. So the sooner they do, the better. But if they have no intention of listing in future or going to public market, they can continue their practices. I don't see anything wrong in that.
Got it. Got it. I think that's a very candid answer, Mankaji, and appreciate that. I'm going to take a couple of questions from the chat box Q&A, and maybe any one of you can pick that up. Ankit M, question: why should India or like country buy or hold USD when it is consensus that value of dollar will go down and US Treasury is a sell? Given the US debt situation, is India being complacent? What is relative of gold paper market LME versus physical? If we go to gold standard at say 10K per ounce, President Nixon movement, what would happen to DXY, Euro, CNY, INR? Is gold revaluation only way to inflate out of the US debt crisis? Gold value oblique foreign ownership of debt under 100%, which is right now at 10%. So given the gold price at 2,400. So net, given that situation that we have, and you talked about the de-dollarization, any one of you would like to comment, Ankit or Gnana?
Yeah, please. I think this question is for you.
Should I take all these questions or just any one?
I mean, you can give I mean, I want to cover all the questions. I think Ria has written 3 questions. I'm going to cover that as well. And then want to come back. I have my own set of questions. And every one of you, please feel free to put it up your questions. I'm going to take it up and place it to the so Gnana, you can be very crisp in responding. Yeah.
See, this President Nixon movement is very interesting because that's the time when they removed the gold standard, and now gradually I think countries are moving towards that, including China and even Iran. So wherever there has been sanctions, Russia is implementing it even very strongly now. So there could be a potential where there could be a barter trade for gold. And it is all thanks to the US sanctions. That's the trigger now. So what could happen to the dollar index, the euro, Chinese yuan, and INR? Many things could happen, but essentially we're talking about dollar weakness. So the underlying dollar weakness could, the undercurrent could really push gold prices, like I showed you in the projections. We're looking at as high as even $3,600, $700. So these are all the triggers that could potentially take it there. And euro could strengthen because of the dollar weakness, not because the eurozone will be doing well, but purely because of the dollar weakness. Euro could strengthen, and Chinese yuan, since they're moving to a new fiat currency, if at all they do, that is again a big game changer because the world so far has been trading their goods largely in dollars. Moving to certain currencies would take time. So far, euro is the only currency which is time tested for the last 20 years. But Chinese yuan is a long way to go, according to me, because I think the world has to get used to stability. So I think they would again take a couple of decades to see if there is stability in Chinese yuan. So to me, I think euro is the biggest beneficiary if that happens, and gold, of course. And INR, on the contrary, could appreciate because of the underlying dollar weakness.
So I just read a couple of questions, rather all the questions of Ria, and again similar questions. How real is this de-dollarization or going back to gold standard? I mean, we all have seen gold standard. Now, after that, we know, like Ankit also talked about $4 trillion print, currency print. Now that we talk about gold standard, is it really real? Or if not, how close are we towards the gold standard? And then I know one case, Zimbabwe has announced the currency to be packed with the gold or backed by a gold, but that again can be an incremental. We can't really undo the things which has already happened. So how real is this? Moving towards a gold standard or a de-dollarization? De-dollarization, of course, is real, but a gold standard.
So a couple of comments before Jana speaks. There has been a lot of talks lately about de-dollarization. I am of that camp that de-dollarization is, if not decades, many years away. So till the time the commodities are continue to be priced in dollars, dollar is not going to go away. Another important factor to notice is that if not dollar, then what? So there is no alternative at this point of time. There have been some initiatives, I completely understand, but they are at a very nascent stage. So it will be many years before something like that or de-dollarization really has to take shape. As far as the demand for gold is concerned, I also tend to believe that there has to be some rationale to how the money is being printed. But right now, the way I am looking at markets is, or looking at gold prices, is that it is also a function of the demand and supply. Right now, the way the money is being printed, the other asset classes, especially equities, are in demand. At some point of time, gold will also attract this money. Right now, this is what has been happening, which is pushing the prices higher. It will push up a little bit. Historically, whenever prices have given such a break, the prices have doubled in the next 2 to 3 years time period. It is possible that such kind of a break and consumption or demand by the central banks globally can push the dollar higher. But exponential exploding kind of a price movement is something which should only be looked from a theoretical point of view at this point of time. So I agree with Gyanshekar that obviously I'm also looking at 2800 at this point of time. In the next 2 years, the price, given the history, it has the potential to go to 36, 3800. But it will not be a factor of the de-dollarization factor will not be the major factor driving this price rise.
Got it.
Maulik, if I take short on this question.
Yes.
So de-dollarization is a very elusive and very misleading term. De-dollarization per se means that the central banks will stop holding dollars, which is not correct. So to my understanding, central banks are increasing gold holding and slowly reducing the dollar. But the gold holding is only 8 to 10% of their total holding. That's my understanding, and that trend will continue. So dollar will continue to be a global currency for a long time. We read a lot of report that due to the high debt to GDP ratio of US economy, I think 39 trillion versus around 25, 26 trillion, the dollar will become a dead currency. That is not going to happen. These are only short term. The US supremacy and hegemony will continue, and dollar will continue to be a very important part of the trade. Yes, central banks will continue to buy. So that's how we see that the China bank, PBOC, had their total gold holding is around 2200 to around 2600 tons. So the increasing trend is there, but where is the gold? The gold supply is not increasing. It is in the same range. And if we say that the gold will touch 3600 in 2 years, I don't think so. I still feel that it should be in the range of for the whole year this year. Should be because the prices have already increased. Should be in the range of 2600, maximum to 2700 for this year. That's all. Because what is the cost of production? The cost of production, to my understanding, is around $1,400.
Correct, sir.
1400 versus 3700. That was huge margin. The market will not allow to operate, and that was the whole purpose that India wanted to take a center stage, because we are buying almost 50%, almost a major part of the global gold, almost 1/3 of the global gold.
Yeah.
So India will be in a totally disadvantageous position if the gold rises to that price, and the government will not allow that.
Yeah, that's I think a very interesting stats, and that's what even Ria also indicated somewhere. The increase in the gold prices impacts the overall imports, and that's what is visible in terms of the additional pressure on the external macros. So very important point. I think I will just offer my one bit on the de-dollarization part. And I heard that probably the dollar supremacy may continue for a long. Just one important news items. We recently it's recently news, Russian assets worth about $260 billion, which was already sanctioned. Now there are talks that the income generated out of that asset to be used to give funds to Ukraine in funding that defense spent. Now this is which is already under discussion. Now that's one side of the story. And subsequent to that, there's another story which is just going round in the circle, wherein Russia has announced, and I think that's a court case, the JP Morgan asset lying in Russia is under sanction by Russian Supreme Court, because they exited the business or exited the country. And in 2022, they changed the law to state that anyone who exits the country has to follow certain protocol, which they broke. And I'm going to now kind of confiscate your assets. Now, point really is that this is exactly what is happening at the global stage, where you have a money which is being, or the reserves which is being sanctioned and not being put to use. Naturally, people will figure out a alternate way. I mean, I'm sure there are decades when nothing happens, and there are days when decade happens. So you never know, what and when. I'm going to pick one more, and I know Gnana, you want to say something on this. I hold it. I just have one question from Ria, which I want to place to Gnana, Bankaji, which is relevant from a purchasing power standpoint, and again relevant to the jewelry industry, wherein it says that, see, if it goes going up, how can the average retail consumer accommodate before it really begins to strain the purchasing power? I mean, at a higher gold price, do you still see same the demand? Will it impact the pocket? Will it impact the purchasing power? Do you see an alternate metal being used in the jewelry? I mean, what's your take?
No, so I don't see any alternate metal being used instead of gold. See, first of all, it's a compact. Let us look at the compactness of the gold. You can't keep silver, 10 kg of silver or 20 kg of silver for the similar value. Platinum, we've seen that the platinum price has not increased. I remember around 8-10 years ago, it was much higher price and the price is currently lower. And platinum bars are not available. To buy a platinum jewelry where you have to pay 50%, 40% making charge. So what is jewelry? People, bars and coins are not a major sales item for a jeweler. It varies from company to company. For us, it is very small fraction, 3 to 4%. So customer buys gold not in the gold form. They can buy sovereign gold bond, but the ladies buy gold for happiness, for investment, and for insurance. It serves three purposes, and I think this is the only industry where you invest, where you spend the money, and you can realize the money with growth. So, to my understanding, there is no alternative to gold. The second question was that if the prices continue rising, will you still buy gold? The answer is same. That when I first time purchased gold for my wife in '96, I had to pay around 4,000 rupees per 10 gram. And today the price has increased to 70,000 rupees, a 15 times growth.
Yeah.
So if it rises to 80,000 or 90,000, somewhere I was reading it will become 125. We don't know it may become, but that will be the value. So one should keep investing in the gold, but that doesn't mean that your entire portfolio. So we read all the standard books. You can't have your entire portfolio in the gold. Decides your risk appetite. It can be 15-20%, but not more than that.
Got
Then
it.
keep investing in the gold, keep investing in the gold jewelry, keep investing in the sovereign gold bond as well.
Got it. Mangaji, recently we heard, and again, maybe a question right for you. And I was talking to a banker, and he says the supply of the gold to India is a challenge. Why? Because from a supply standpoint, Chinese are willing to pay more premium than Indian markets, and therefore the gold availability for the Indian retailers or Indian jewelry manufacturer from the supplier is relatively costlier. I mean, is this availability of a metal, is this really a challenge that you see moving forward, given the Chinese appetite for buying more?
So at a macro level, maybe you can answer, but as a jeweler, almost 30% of the gold is coming from recycling, 28%. Some precise number you can refer to our quarterly report. And for one large jeweler, it is almost 35 to 40%. A major part will come from recycling because we don't make money on the gold purchase and sale. It can only and as far as the major part of the gold we take from the gold metal loan from the bank. So there are large banks and they have got their own entire supply chain. So we have not faced any difficulty. And irrespective of the global price, there will always be a price differential between China or Dubai or India. Here in India, we pay almost 15% higher. But the gold demand has not decreased in India because customers ultimately look at the prevailing prices in India. Customers do not look at prevailing prices in China or Turkey or Dubai.
Got it.
So I don't see any reason that the gold price in India will be constrained by the Chinese higher demand. Only the prices can increase substantially, but supply to India will not reduce. The whole ecosystem which we have created in India, that entire ecosystem cannot be impacted simply by Chinese are buying maximum what? Maximum 200 to 300 tons they will buy extra. That's all. Last year also, I think they bought 200 ton extra out of the 3,600 tons of global demand.
Got it. Got it. Let me come to Gnana. I think Gnana, a couple of questions for you. Jay has asked, we have seen disparity of 1,800 rupees. And this is quite often we see, Gnana, the physical gold market and what we have as a conversion for dollar to rupee. Many times there is a disparity. Many times you see the future at a discount, like immediate June or June over August. So how does this entire thing really, is there a method to this madness? The physical market, the future market, the bank, GML market?
No, it has its own dynamics. I think the physical markets have its own dynamics. And basically, this disparity is also because of the dollar rupee. It's been quite stable for the last 1 year, and then suddenly you saw a dollar rupee shooting up. Like you said, it's like a decade happening in one day. And dollar rupee was like in a range, like a dog tied, and then the dog was released and it just took off. That is one of the key reasons where you've seen international gold prices rising. Typically, because of the inverse dollar correlation, you have the local prices steady or coming down when international prices go up. But that's not been the case now. So you have both, the international prices have risen and the domestic prices have risen because gold, the dollar rupee is also weakened quite a bit lately. Though RBI has been, intervening quite often, but it's not enough because we are compared to the pure currencies, the other Asian currencies, we're still extremely overvalued. So there's a lot of scope for the currency to depreciate, though RBI might not allow a very sharp depreciation because we have enough reserves now to counter that.
Sure.
But the point is that mostly it's to do with the current dollar rupee, and that stabilizes. I think we'll see the disparity coming down to some extent, and also the present sort of demand that we're seeing across the across sectors. That's resulting in some sort of near-term cash, near-term availability. But it's expected that future there will be enough availability. So that's why you see these discounts in the future and premium ruling constantly. The premium discount is purely a function of the market's perceived threats going forward and the present situation. And this has been always. So I don't think we can call it madness, but it's pure, demand supply dynamics.
But I think one thing is, as a market practitioner and participants, I can say that this actually offers a great opportunity for the hedgers. Like, for example, today, whether you are a jewelry manufacturer or the retailers, having an access to MCX future or a bank go for gold forwards, or now with the new RBI circular, which allows you as an Indian resident to even access OTC in GIFT City. So if you have a bank which is present in the GIFT City, you can go there and hedge your gold risk, but international. So with all this access, I think this future premium and discount, depending on which market is the most efficient, I think that really is an opportunity that one can really explore. That if it is in discount and if I really want to hedge myself by buying, then I will probably choose the market which is much cheaper, and vice versa. If I'm a seller, I'll pick the one where I have the maximum premium. So I think those are the opportunities that it really market inefficiency offers. I'm going to put one question to Bankaji. I think this is related to the point that you mentioned. Nirmal Meharaji is asking, is it the time to resume the mining in some Indian mines, given the margin that you'll have at a higher gold price, which was disabundant earlier? Any comment there? Abundant earlier. Yeah.
Well, definitely. See, I was talking to one of my friends, and who is working in a top Indian conglomerate, you can assume. So he said that no, we are going to start mining, and with a capacity of 30 tons. My understanding was the India gold mining capacity is only 1 ton. But then slowly I realized that no, other companies are also producing. So, but this group is going to mine almost 30 tons. So obviously this is right time because whatever is the cost differential, that must have come down and it must be making sense. But I don't have the number as to how much money the miners make. So let the other experts come in. But time is right. Yes.
Yeah. Any comments on the mining opportunity in India? Gnana, if you have been studying the demand and supply, especially the supply one.
See, traditionally in India, I think like Bankaji mentioned, it's largely recycled, supply which has been sort of holding on so far. New mining opportunities, there have been some, but it hasn't been explored. But with these high prices, certainly there will be, new possibilities. I don't know if it will fructify, but there will be possibilities for sure. And who knows, something might come up soon.
Amit, I'm going to put up the next question to you. Should India hold lesser US Treasury? Ankit M is asking as a percentage of FX reserves.
Okay, so what my understanding is, generally the countries try to hold, or especially India tries to hold almost 10% or 10 months of their import liability. In terms of dollars, so currently we are importing almost 700 billion worth of, or rather 880 billion worth of imports every year. So 10 months is approximately about 700 billion. Right now, the gold reserves are at somewhere around 7.3% or so. So mostly, of course, there will be a gradual increase, as Banka Sahab said. There'll be a marginal increase in the gold reserves in terms of percentage, but I don't see a significant shift in the way the dollar and gold ratio change. So it can probably move towards 10, 12%, 15%, but not beyond that. So because for our trade purposes, we will be requiring dollars and euros. So a major shift to me from a market functioning point of view looks extremely unlikely.
Got it. Got it. And we have the last question from Naresh Aneja. Even at this rate, customers shying away from the market, small operators are vanishing fast. How do you think USD 2,700 will sustain? I think Bankaji already responded that he has been buying gold for his wife and it was as low as $100, and now at 2,400 also is a buyer. So it will sustain. Maybe I think it's more a question of market adjusting it, accepting the new levels, which probably could be a time corrections in our financial market terminology, I can say. And probably with all the volatility in the time to come, probably we are talking about the new range, definitely way behind what we used to be last year, sub 2,100. So I think market will sustain and consumer will accept. You and me will definitely buy, because we also believe in 30,000 tons somewhere I read as an Indian household holding has been bought at different levels. So I'm sure we'll continue to buy. I'm going to quickly sum up. Yes, Bankaji, you want to say something?
Yeah. So you started the session with a Hindi song. I wanted to give other flavor of the Hindi song. The Hindi song which says that Sona kitna sona hai, सोने जैसा तेरा तन.
Yeah.
तू मेरा तू मेरा तू मेरा तू मेरा तू मेरा hero number one.
क्या बात है.
Gold will remain the hero number one as far as the investment for the general masses is concerned. Those who don't understand equity market.
Fantastic. I think that's a great way to close and conclude the session. It's been fantastic. I'm just going to quickly sum up the discussion point. And I think so there is no debate around whether gold is in a bull run or not. I think more or less we have enough triggers to support the gold rally. There could be a corrections, 10-15% Ankit talked about, and probably we are looking at a newer highs in the time to come. And there are various reasons as explained by the experts, whether it is a de-dollarization trend, excessive money supply, eventually more and more regional blocks getting formed, and the central bank diversifying. All of that has an impact on the jewelry market, yes, for a temporary period. But looking at the way Indian markets are, I think Bankaji rightly said that we will continue to be a gold buyer at different price point. It's just a matter of adjusting it. I think another key factor that Bankaji touched upon, especially if you're a jewelry manufacturer or the retailers, especially on the hedging policy. And a very strong message, your objective has to be well defined. If you're a listed space, he has his own experience of facing number of investors who talked about hedging policy. Whereas, if you're an unlisted space, probably that community you're not facing, and then you can make your own judgment. I think there are various market to hedge. Inefficiency offers the opportunity. That's something worth exploring it. Yes, Gnana, you wanted to say something, and I'm going to give you all of you a closing remark. And Bankaji, one thing that I expect from you is being a successful IPO. You have that experience. What's really the key message for the participants? But before that, let Gnana comment. Yes, Gnana.
I just wanted to quickly touch upon this very key thing Bankaji talked about, that mutual funds are keenly watching how much hedging happens in a listed company. My sense is, I think they tend to overplay the risk and underplay what potential profits the same organization can get if a certain percentage. I'm not saying 100%. I'm not talking about 20%, even 10%. If they allow the scope to de-hedge or unhedge, that would result in a huge change in the P&L they all look at one big benchmark, which is Titan, and then they say they hedge 100%, and therefore everyone should hedge 100%. That might not be the right case. With the direction that gold is showing us going forward, listed companies are bound to. There's going to be huge opportunity losses if you have 100% hedge. And then these organizations or mutual funds should allow these listed companies some scope to sort of take advantage of this potential rise. So that is something which I wanted to touch upon.
No, so you are absolutely right, but the fact remains that they don't even, so in their mind they want 100% hedging. If you are doing 90%, still you have to explain why 90%, what is the impact of 10% unhedged, how much the profit. So in their mind, not even Indian, even the foreign investors want you 100% hedge. It is a company management policy and decision, and then to their respective set of investors who have invested, and there are some who have not invested. So some have not invested, so they are not interested because they wanted a higher percentage. Those who have agreed at 80 or 90, they have their own set of rules and regulations which we have to follow. There is opportunity gain and opportunity risk also. It's a very complex game. So to add to now the final query which Maulik asked, see, to our understanding, when we went for the roadshow, the jewelry sector on a listed space was not existing. There were only two, three companies, Titan, Thangamine, and Kalyan. But in their mind, they were looking only at Titan as a benchmark. So we had to struggle a lot when we went for the roadshows, and we are very happy that after our IPOs have come, Manoj Vaibhav, your manufacturing company, Asapuri, some Sky Gold and whatnot. So those, and they've all been successful, Moti Sons to be notable, and we are very happy for them. So to my suggestion to all the CFOs of jewelry sector would be the first challenge for them would be to build the trust, because there are a lot of queries about the sector, about the cash payment, about anti-money laundering, about breaking of invoices. So trust has to be built up, and trust you can't build up only by words. That okay, you are starting IPO in 25, and 3 months ahead of your IPO start changing all the policy. That will not work. You have to establish trust over 5 years and 10 years. So anyone who has an aspiration, and I think that with the success of Senco and all that, everybody should try to enter into the sector. Sector will become quite large, and so trust has to be built up over a period of time. So if you have to take any action, start taking it now, whether it is 2 years or 3 years. But if you just go to the market without building the track record, the IPO may not be so much successful. And at the end, I want to compliment Maulik and his team for working with us. For last 3 years, Maulik has been guiding us. So I was almost new to the jewelry sector. So coming from a telecom background, Maulik and his team, they have helped us participate in the journey, in drafting our hedging policy, in guiding us. And we are very happy, Maulik, working with you.
Thank you so much.
So whatever I've spoken today, I've learned it all from you. So entire credit goes to you.
Thank you so much for your lovely and kind words. It helps us. It's a live client testimonial. What better can I expect? So nice of you, sir. Thank you so much. Yes, Ankit, last word before we end.
Nothing much. I think most of the things have been said. But when I was in college, my professor used to tell me, finance professor, okay, only look at demand supply. If the demand is up, the price will go up. Now, what I have been seeing lately is that the money supply has demanded equities. The price go. So I'll just give you a number. At 10,000 Nifty, SIP was 8,000 crore per month. At 22,000 Nifty, we are at almost 20,000 crore per month. So such kind of demand has not come for gold, and probably it will take some time. Having said this, gold is definitely a buying opportunity, and I continue to feel that probably a 2002 or a 2009 kind of a scenario, replication of that kind of a scenario is very much possible. So any dips in gold towards 2200 or 2250, whenever it comes, just go and buy. It's a blind buy opportunity whenever that price hits.
Got it. Great. Excellent. Thank you so much, Bankaji, Gnan Shekhar, Ankit. Indeed, really grateful to all of you for sharing your insights. And thank you all the participants who have been still there with us. Really enjoyed interacting with you and taking up your questions, placing it to the speakers. Thanks so much. Thanks. See you at the
Thank you,
next
everybody.
session.
Thank you.
Thank you. Thank you.